In this presentation, we will record an advanced customer payment or deposit. In other words, the receipt of a payment from a customer before goods or services have been provided. In our case, before the inventory is provided of a guitar, we receive an advanced deposit within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. We're going to go through the objective up top by selecting the plus item. We have entered an advance payment before, so we won't go through the full scenario, but just remember that there's a couple different ways we deal with the customer, a couple different cycles that are typical, and those cycles will differ depending on the type of industry we are in. In other words, our typical cycle, if we were something like a law firm, is probably to do the work, then send the bill to the client, and then they pay us and we receive the payment in the mail, and then we go to the bank and deposit it. Or if we're something like a food truck or some kind of restaurant, something like that, we typically will then get paid at the same point in time that we provide the service, those two things happening at the same time, then take that money, go to the bank at the end of each day. However, some industries are such that we get paid before we do the work. Something like a magazine, or newspaper subscriptions, or any kind of computer applications these days, we actually get paid before we do the work. And in those cases, then we have advance payments. Customers paid us before we did the work. What do we do about that? That's unusual. It's a bit different. In our case, as is the case for many types of businesses, if we are going to engage in a large project or hold on to an expensive piece of inventory for a customer, we may ask for a deposit, which is another form of advanced payment. That's what we're doing here. We're going to provide a guitar. We're imagining someone came in. It's going to be a customer called String Music is the customer for us. They came in. They want a guitar. We don't have it right now. We're going to say, hey, we'll order it for you, or we'll hold on to it for you. However, in order for us to do that, we want you to commit to it by giving us a deposit, part of a prepayment now, which we haven't earned. We will earn it when we provide you with a guitar at some point in the future, either when you come in the store or when we order it from the vendor specifically for you. So that's going to be what we do now. We're getting that advance payment. To record the advance payment, we're going to go to the receive payment item, an item we usually only use with relation to an invoice, but this time we're entering it before the invoice, which is a little unusual. So we'll select the receive payment item, and we're going to enter this for String Music. That's going to be our customer. We can do that with the drop down or type in String Music. There we have it. As we tab through it, we're going to get this little message, and QuickBooks is kind of saying, it's telling us, hey, this is a little unusual. You're doing this a little bit backwards for most industries. I'm paraphrasing here. Why? Because you'll note down here that there's no invoice related to it, and we have a receive payment. The receive payment means that part of the transaction is accounts receivable is going to go down. Accounts receivable is going to go down for this particular customer, String Music, even though they don't owe us any money. They don't have any outstanding invoice. How is it possible that accounts receivable goes down when they don't owe us any money? It's going to go negative is what's going to happen. And that is not exactly correct from an accrual basis. We shouldn't have a negative receivable. We should have a positive liability. However, we typically will use this, or many people will use a negative receivable and record the sales receipt to record on purpose a negative receivable rather than a liability that's positive. Because if we use a liability account, if we just enter this with a journal entry, it'll be less difficult. The system won't know as easily to tie this out to the sales receipt or invoice when we actually provide the good or service, the guitar in our case, in the future. So this will be a little bit different, a deviation from the financial accounting that we know. When presenting the financial statements, we'll adjust for this for adjusting entries or with adjusting entries at the end of the period. And we'll see that so you get an idea and a feel for that. So just note that this will typically differ than we might see in just a normal journal entry process for financial accounting. It's done that way oftentimes in order to help the system to link together and track the information not just by overall accounts, but by sub-accounts, by customers. In other words, linking the payment that we received before we actually did the work, before the form we will enter to record the work being done, the sales receipt, and the invoice. The date we're going to enter as of the 21st, so 2/21. We're going to say the payment, we're just going to keep it at cash for the payment. It's going to go into undeposited funds as is typical. We're going to change the amount on the side to 300. So we got 300. It's not being applied to any invoice. So what is this going to do? It's going to, as always, decrease the accounts receivable. That's going to be the transaction, making it negative for this particular customer. Not accounts receivable as a total, because that's all customers, but for this particular customer, we have a negative receivable, meaning we owe them money, not them owing us money. And then the other side is going to go to undeposited funds as normal, increasing undeposited funds. So we're going to save and close this and check that out. QuickBooks is once again telling us, hey, this is paraphrasing, we have given a credit to this customer, meaning there's an advanced payment. And that's the point. That's exactly what we want, because now QuickBooks knows that, tracks it by customer, and when we make an invoice or sales receipt, we'll apply that credit. In other words, apply this amount out to the amount due for that customer, decreasing the balance that they owe once we record the invoice or sales receipt. So we're going to go ahead and save as a credit. That's what we want. Then we'll see the reports. We're going to go to the reports on the left side. Starting with the balance sheet, so we'll open up that balance sheet. We're going to change the dates up top from 01/01/19 to 12/31/19. That's January through December 2019, and run that report. If we scroll down, then we're looking at the accounts receivable. There it is. Selecting that item, we see down here that we have that 300 negative, so it's decreasing the accounts receivable. As we select that item, we, of course, will see that receipt payment not applied to any invoice. Closing that back out. Now we're going to go up top and open up another report. So I'm going to right-click on this tab so we can do it on another tab and keep this report open and duplicate that tab. And then within the duplicated tab, we are going to go to the reports. And we'll select and scroll down to the who owes you money, the money that's owed to us, the company. And we want to look at a customer balance detail report. So here's the customer balance detail. And as we scroll through it, we see the total is $2,240.27 cents. It's a positive number. If I go back to our master account, to our balance sheet account, and scroll to the right, we see that's $2,240.27 cents. That matches out. That looks good. If we go back then to our detail by customer, we see also, however, that there's a negative amount for this customer. This 300 is negative. How can that be? That doesn't mean they owe us money, as is the definition of a receivable. That means we owe them money. That's okay. We can see that. We can know what that means. Obviously, it means there's an advance payment, but it's not reported completely properly from a financial statement standpoint. It shouldn't be a negative receivable. It should be a positive payable. And we will make that adjustment if we need to at the end of the time period so that we can report our financial statements overall properly by not having that 300 be a negative. This shouldn't be decreased in the total receivables. It should not be included and be a liability. However, this will work itself out when we have the payment, the invoice that's going to be related to this payment, which we'll enter afterwards. It'll then match out and everything will be fine at that point in time. If we had not recorded this payment in this format and instead used a journal entry, then we wouldn't be able to run this report and be able to see as clearly the matching up by customer of the advance payment and the invoice or sales receipt that we'll enter in the future. That's the purpose, that's the logistic reasoning for doing this, even though from a financial statement reporting standpoint, it's not the proper way. It doesn't look good. There's a timing difference where there's a problem, and we'll just adjust for that difference just like we do for any other type of a timing difference or problem or deviation from a perfect accrual basis. We'll account for it and make that adjustment periodically when we create the financial statements at the end of the period, at the end of the month. For more accounting information and accounting courses, visit our website at accountinginstruction.info.